Trying to let's see. Hello, Richard. This is a different format, so trying to get used to it. Again, if anybody has questions, let me know in the chat box. See if folks show up. Doesn't allow me to take off the camera either. um, that's all right. For those of you who just joined, if you have any questions, let me know. Talking markets, economy, any pressing issues, Fed, rates, yields. Thoughts on the down day with low volume? Volume is not an indicator. You can use it for various things, and unfortunately, a lot of people do, but it's not practical. Markets tend to go down. To your question, it usually do have more volume on down days. Why? Because selling is emotional, buying is a process. You've heard the saying before: markets go up, they use the stairs going up. It's a slower process, but markets take the elevator going down because it's an emotional trigger. So selling tends to, be characterized by heavy volume, especially days where the market is down 1, 2, 3%, like today. So it could be it is just one trading day. If you put a string of trading days together where you have low volume and yet the markets are down rather significantly, then you can, call it into question. But either way, from a practical perspective, what can you do with that? Ideally, down days like this, you look at and you say to yourself, where are my buy zones? I'm getting value. I'm getting a discount. Do I have a game plan to take advantage of cheaper prices? Or am I just afraid? Am I getting the majority of my if you will, media, financial media information and insights from, Twitter or CNBC, so on and so forth. So it is just one day. This was bound to happen. We got overbought. We've got yields now, 2 weeks worth of upside here. A lot of that you can blame on the Fed to your blue in the face. Again, none of this really matters. Anything that happens during the course of a trading day, you say to yourself, you step back and you want to know the whys, right? We're human, so we inherently want to know the whys so that we can rationalize our actions. Ultimately, you're never going to know exactly why. The market is not going to send you a message, hey, an email saying, hey, today the market was down because, my mom bought vanilla ice cream instead of chocolate ice cream, facetiously enough. Having a game plan is really what the average investor needs to focus on. Most people are just going to sit on the sidelines, with a day like today, seeing if we get follow through to the next day. I was a buyer today. I share that with our Phenom Group members in our trading room throughout the course of the day, 8:15 to 4 o'clock closing bell. We're in the trading room talking about all the various facets of the market. We're looking at intermarket correlations. We're looking at what yields are doing across the curve. We're looking at what oil is doing. We're looking at gold. Are we getting confirmation from the dollar? These are all the discussions that we're having during the course of the trading day inside the Phenom Group trading room. But even so, we're for the most part, we're acting. Yeah, the stock market is the only place where you get a discount and people go running away from it. If Macy's, I often say, and maybe you've heard this before, if Macy's is having a 25% store wide sale, are you running away from Macy's? No, but we tend to, it's human behavior when they think about their capital actually getting lost or, devalued, to look at a discount and saying, no, no, it'll get worse. I'll wait for tomorrow. Look, it may get worse. Or we may have hit the top in yields. The 10-year yield may have topped out. Maybe it tops out at 4%. Nobody knows for sure. But all the while, if you're just waiting, sitting on your hands, you're losing time. You're afraid that if we have a follow through date, then take a smaller position. Buy in smaller increments on the way down, as opposed to just sitting on your hands. Today, I was a buyer. I was able to recapture some shares that I had sold in Verizon at a higher price, but back under 40 for a change. Was happy to do so. What else? Google. I have been trading Google in and out. Happy to get those shares at basically my lowest trading price. During the current cycle. Other buys today, Oxy. I bought some Oxy under $60, right? I mean, that seems to have been the floor lately in Oxy Petroleum. Shorting volatility, right? We're above 23 or maybe around 23 on the VIX. When was the last time we've been here? Good opportunity to short volatility. I'm not a buyer of volatility. You don't buy volatility. I mean, you can, but it's not the best idea, so to speak. Anyways, I got long-winded. Hopefully I answered that first question, to your satisfaction there, Paul. Sorry, again, I got long-winded there. Can you quickly explain risk on versus risk off for new people? Sure. So risk on is generally when you see risk assets. The definition of risk assets, usually the stuff that you're paying a premium for. Okay, anything that you generally pay a premium for is defined as a risk asset. So equities, you tend to pay a premium for. Obviously, Bitcoin, I think we can all be in agreement there that Bitcoin is a risk asset. So when these asset classes and various sectors of the stock market that are defined as risk on are moving higher, it's a risk on environment. When it's a risk off environment, you have defensive asset classes, and you have defensive sectors of the equity market that are moving higher. For example, today, and I'm sorry, I don't think I can share my screen, but if you go and look at the typical defensive or risk off sectors of the stock market are consumer staples, healthcare to a certain degree, because that's also growth, and utilities and real estate. Right. And I think they all outperformed today. They were all down, but they were down less than the overall market. So it was a risk off day. The defensives fared better than the offensive areas of the market. So consumer staples are what most people look to in order to divine, that it's a risk off market. Consumer staples. And those got a nice bid today, in part because of Walmart. Walmart outperformed today, beat on the top line, beat on the bottom line. Guidance was light of expectations. Margins were light of expectations. But as I said to our Phenom Group members, this is ridiculous that they were selling it in the pre-market. I had a feeling it was going to go green. It went green. But consumer staples are risk off, defensive, and they outperformed today. Risk on would be the opposite, consumer discretionary, offense. We consider that offense being on the field, or that's what's working in the market. Consumer discretionary has been outperforming consumer staples so far here in 2023. That's your risk on, risk off. Today was a risk off day. All of the growth areas of the market, all of the offensive areas of the market underperformed. All of the defensive areas of the market outperformed. To be honest, when you look at Bitcoin, when you look at crypto today, kind of outperformed. It wasn't as risk off in the crypto complex as it was in the equity markets today. So Good question. Thank you, Tom. Uh, let's see. Any thoughts on the 10-year yield? Yeah, I think you heard me already there, Carlos. Any thoughts on the 10-year yields moving again to the 4%? Again, I wish I could share my screen. I'm just getting used to this format. We talked about this. We actually looked at the chart of the 10-year yield in our macro research report. Again, this is every Sunday at phenomgroup.com. We deliver a macro market research report. It has your fundamentals, economic data. It has your technicals. It has your quantitative data each and every Sunday, as well as, every week we do a state of the market video as well, where we go over these three disciplines. Three disciplines, of investing are technicals, quantitative, and fundamentals. So we do a nice dive into each of those areas or disciplines every weekend in our macro market research report. But when we looked at the technicals for the 10-year yield, what we understood was, and most people are probably familiar with the fact that we broke that downward sloping trend line in the S&P 500, right? We broke above it here with this recent, call it a bull market rally, an emerging bull market rally, a relief rally, a bear market, call it whatever you want to, but we broke beyond that downward sloping trend line that was in place all last year. Well, guess what? The 10-year, same thing. It broke above it, in the same way that the S&P 500 broke above that downward sloping trend line. So from that perspective, we understood that there's a good probability that the 10-year would go higher. The second thing we looked at so far as the 10-year technicals was it overheated? Because we've been on a pretty sharp, rapid move to the upside in yields across the entire treasury curve. So we looked at the relative strength index. The 14-day RSI was at 63 coming into the day. Was that overheated? No. Was it hot? Yes, but it wasn't overheated. An RSI 70 or better is defined as overheated conditions. So we had a break of the downward sloping trend line, positively, inflecting upward, and we're not quite overheated on the 10 years relative strength index. That informed us that there's the probability of the 10-year going higher was better than the probability of it going lower, at least near term. Nice round hole numbers, 4%, right? That is what we thought would be the objective near term for the 10-year yield. And with that in mind, it would probably be difficult for equities, to continue rallying. So that's what we outlined in our macro research report this weekend. At 4%, that could be a nice topping point. Now, here's the thing to keep in mind also. The last time we were at this exact level in the in the 10-year yield, let's call it 3.95%, 4% if you're happy, was September 27th of last year. Now, the interesting why I point that out, again, this is exactly what we talked about in our trading room, is that the S&P 500 was at 3640 on that day, closed at 3640 and change that day. And why I bring that up is because that's how much more the bearish sentiment needs for yields to go even higher to get back down to those levels. We're, for round number sake, again, 400 points higher than where the S&P 500 was when the 10-year yield is exactly where it is today. The impetus is on the bears. They've got to make it happen. And I just don't know that there's that much in the tank for the bears. I think it's a very reasonable probability that we top out, at 4%, at least for the interim. And that could provide the fuel for, a basing here of this consolidation phase in the S&P 500 before inflecting higher again. We'll see. Again, nobody knows what's going to happen next in the market. That's why we perform these, analytics, if you will. Let's see. CNBC Mike Santoli just said 10-year bonds seem a bit yeah. So we looked at it coming into this week. The 10-year yields RSI was at 63. but it finished today, last I checked, at 69. I would venture to guess it hit 70, which is the threshold for overheated, overextended conditions. Excuse me, still trying to get over a cold here. Caveat, or caution, right? Things can get overbought and stay overbought for longer than most people care to consider. In the same way that things can get oversold and stay oversold. So all we have are our disciplines and our probabilities to lean on. But indeed, this move seems very, very toppy in the 10-year as well as the 2-year. And the RSI is validating that. So we would, be looking for, anticipating, if you will, some near-term consolidation in yields. Tomorrow we have a key. It's not an event, but we do have the FOMC minutes. Maybe that will provide the impetus for yields to consolidate this move and kind of put a floor in this consolidation phase for the equity markets. We'll find out tomorrow. I always look at things and say, I'm okay with down. I really am. I'm okay with the market going down. I've got ample cash on the sidelines. I've got a game plan of where and what I want to buy. So down is good for me in the near term. If it doesn't materialize, I'm positioned for upside also. I've got my core holdings, my long-term investments. I got some trade on the board. Phenom Group has trade alerts that we initiated late last week, even here today, as markets continue to consolidate. So it's a win-win. We go down, I've got cash to deploy. We go up, I'm probably taking some profits on trading positions. And that's really where you want to find yourself as an investor, setting yourself up with win-wins. The more that you can set yourself up with win-wins, that becoming a routine, you're probably going to do quite well over time. Let's see. Since TNX broke out, everybody's been watching yields, which is a good thing. I actually enjoy seeing that folks are looking at the intermarket dynamics. They're rationalizing why we were able to move almost to 4,200 on the S&P, but yields were much lower, right? But since we've gotten this rally, now we're looking at the right things to validate, why the equity risk premium is being called into question again. All right. Let's see. 2% pullback today, not so bad. Don't we have a stat on the 5% pullback? Actually, on average, right? On average, the market tends to have 5% pullbacks annually. On average. I mean, sometimes you'll have 4, other times you'll have 1, right? 2017, you had 0. We had 1 in 2021, right? That was September. Up until September, we had like no pullbacks. Then September came, the September swoon, as it's known, and we had a nice, 5% consolidation there. So. Don't see any more folks joining, but if you have any other questions, feel free. Individual style, my expertise is generally volatility, consumer goods stocks, retail. If you have any questions in that neck of the woods, so to speak, feel free. If you have any questions about what we do at Phenom Group, feel free. This is the time. I'll try and do more of these as the year progresses as well. Thoughts on Amazon long term? Can I put a heart out here? A heart emoji? That's how I feel. Let's see if that works. Yep, there you go. Long term, it's been quite some time since you had this kind of value opportunity with a stock like Amazon. And why folks will, scream to high heaven as to why, Amazon has finally gotten its comeuppance so far as valuation is concerned. No, if you look back at the history of Amazon stock, it's had, I think, 7 different 30% corrections since it was, since the turn of the century, 2000. I don't count before 2000. We didn't have EFs and whatnot, but yeah, I own Amazon. we've been building our core holding in shares of Amazon. I think we have like I want to say mid $85 core holding cost average in Amazon for Phenom Group traders. You may have seen me post periodically our completed trades, and that's how we go about building core positions. We look for 1% scalps, and let's say you buy 1,000 shares. We'll sell 900, keep 100. Then we look for the next opportunity to buy it, hopefully on a dip, and we get the 1% profit. Sell 900, keep 100. Now we've got 200 shares. Rinse, wash, and repeat. And that's how we go about building our core holdings and giving us a really strong cost average beyond where the current market pricing is. And that's why we've got I want to say it's around $85, $86 a share cost average. So yeah, I like it long term. I think and in terms of the sector, right? That's consumer discretionary. Amazon is the most heavily weighted stock in the consumer discretionary ETF. If you look at the EPS projections by sector for the full year, consumer discretionary is expected to have the highest earnings growth rate this year. What's expected to have the lowest earnings growth rate this year? Anybody can guess? It's energy. Energy. It's a complete opposite of what we saw last year. Energy had the greatest earnings growth last year, and consumer discretionary and communication services had the worst earnings growth, right? But that's what happens. You set a low bar, right? It's easy to jump over. It's not as if I expect or anticipate some, fantastic record-setting earnings out of Amazon this year. I don't. I just think that the bar was lowered so low, and they had spent so much in terms of just investments as well as capex that's going to be reduced. They've laid off or are in the process of laying off thousands of workers. That hits the bottom line favorably as well. So you set a low bar, you kind of reduce operating expenses, SG&A expenses, and it makes for an easy year-over-year improvement. Let's see. Why are folks so short-term? Seasonality is extreme. I guess you can say, in the market, unfortunately, people like or they desire quick rewards. So they think in shorter time spans, if you will. And if it doesn't work out that way, they either take the loss or become disgruntled. The market's manipulated. It's not me. It's the market's manipulated. It's never their fault. But to that point, the longer time horizon, the greater probability that the investor will find a profit in that particular trade or investment thesis. So yeah, we live in this era of social media where people they want that information quick and they want that reward, that profit just as quick. It's just the human condition, human nature, if you will. Is it just me, or is this market drop bullish? I like the outlook. I mean, I like that sentiment for sure. I'm a glass half empty kind of guy. I'm always optimistic. I've been investing for 23 years now. I've never known the pessimistic view to reap rewards long term. It doesn't work. It just doesn't. There's no such thing as the world's greatest short. The world's greatest short investor. And people always say, well, what about Jim Chanos? I'm like, have you seen Jim Chanos's annual returns? It's a nightmare. You don't want to be in that business. He may be the best in that business, but it's still not a business to be in. So, it's popular to be bearish, to be pessimistic, cautious. It sounds smart, right? It sounds smart. Oh, he's not just throwing caution to the wind. He's thinking about it. That always sounds smart. When you're bearish, you sound smart. The problem is when you act upon that sentiment, when that becomes your absolute strategy. because it doesn't work practically in the markets. The markets are up 75% of all years. You want to be leaning into that probability, not away from it, but for the sake of drawdowns. People are afraid of drawdowns. You know, arguably the world's greatest fund manager of all time, Peter Lynch, 1979 to 1991, managing the Fidelity Magellan Fund. He always admitted that every market correction, every bear market that he was involved in, he did worse than the market, meaning he took a bigger drawdown than the S&P 500. But he always managed his cash wisely to continue to allocate. And what you allocated at those, 10% of the low, 5% of the low, at the low, becomes compounding gains on the way to the upside. So, people are afraid of drawdowns. I've never known a single, fund manager in all my years of, consulting with the various hedge funds. I've consulted for some of the big boys. I've never known of a hedge fund manager that can have a I guess you could call it a similar disposition. They're not willing to take a double-digit drawdown, but they're able to achieve a double-digit reward. It doesn't work that way. The mind doesn't allow for it. You halt the drawdowns to the downside. What do you think you're doing to the upside? You're doing the same thing. It's generally very recursive. It's just human behavior. If you're not willing to accept a double-digit drawdown, most people are not willing to accept or achieve, I should say, a double-digit return. Again, sorry I got long-winded there, but hopefully some of this, that's what I do. Let's see. Dollars. I mean, the dollar move is concerning because at 105 we start to get problems. It's no longer just a dead cat bounce, a relief rally. It starts to look like a breakout. Again, this is what we've discussed as of last week with Phenom Group members. Is 103, 104, okay. It still qualifies as a dead cat bounce, to be expected, highly anticipated. We're not going down in a straight line any more than we were ever going to go up in a straight line and just keep ripping. We went from 114 on the dollar index down to 101. In basically what, 45 days, month and a half. So we highly anticipated a bounce from where you never know. But if this bounce gets further extended and you start to see a 105 handle, markets are going to have difficulty with that, mainly because of the Forex exchange rates and what it means to these multinational companies' bottom line. So 105, especially with yields being where they are, is going to be problematic for the market again. I would say. Markets are going to at best churn, if those conditions are what we see in the coming days or weeks. I'm doubtful. I don't think there's the macro climate that supports 105 or better in the dollar. I just don't think it's there. Why would you be flying to the safe haven dollar, given what we're seeing in foreign markets? When I say foreign markets, I mean the economies. The developed economies, China reopening and what we're seeing in their takes in PMIs, which is spreading to Europe. And now we're looking at European PMIs, Germany's PMI out this morning, and we're seeing back in expansion territory. And we're seeing the threat of recession also abate from the forecast in Europe at this point. So the flight to the safe haven dollar, that impetus just isn't there, in my opinion, to support 105s or better on the dollar index. So whereas I've said I think the 10-year yield does have high potential to 4%, and that's probably where we'll see some kind of island reversal pattern. The dollar, I just don't think has those kind of legs. I could be wrong, but that's what I'm thinking at this point. What I also encourage folks to do, at Phenom Group today was go check your McClellan oscillators. Right, this has been what we're down 3 days in a row in the markets, in the S&P, in the Nasdaq, and it's pretty good decline. More than 3%, almost 4%, I think, on the S&P 500. So I'd be looking at your McClellan oscillators to see if we have overextended, been and gotten into oversold conditions. McClellan oscillator has been a really good tell so far as the impending bounce off of unsold conditions all last year. I wouldn't expect that to be any different here, in 2023. Things have happened and materialized pretty quickly, to the downside here. I don't see pivot. I saw the word pivot, so and I'm sorry if I'm jumping out of sequence here. Again, this is my first live video cast here, and thank you for coming. Thank you for introducing your questions. I don't see a pivot as a good thing. It means too much was done and it's forced, rather than taming inflation without a recession, and they can ease into normalizing yields to 3% without QFI. Yeah, I mean, I agree. The whole pivot conversation, um, you know, we have so many tools, right? As investors nowadays, we have so many tools, right? Fed Fund Futures, and everybody can go see Fed Fund Futures. Just, type in CME Fed Watch Tool if you're not familiar, CME Fed Watch Tool. I'll bring it up and I'll see if I can put it in the chat box here. So if you're not familiar with it, you can get familiar with it. All right. Whoops. Okay. See if that'll paste. Yep, there you go. All right, it's in the chat box. We have so many tools that we can become a detriment to ourselves. Folks, there was never going to be a pivot. This is a 40-year epic, inflation cycle in the making. There was never going to be a pivot. The only reason why we even contemplated that word is because Fed Fund Futures exist and they show, right? They've been pricing rate cuts in the back half of the year. Is the S&P 500 constant? Meaning, does it just stay where it is day in and day out? No, right? Because you have millions of investors, thousands upon thousands of market makers and fund managers that are interacting with price. This is the same thing with Fed Fund Futures. They're not constant. At one point, they were pricing rate cuts. It didn't make them any more probable than improbable. They just exist. And so people can go there and see what's being priced. And now there's a narrative that goes along with that pricing. Right? It's not the narrative that drives price. It's the price that drives the narrative. But there was never going to be a pivot, folks. The Fed had told us this long ago. A pause at best, and they would stay higher for longer. But because we have Fed Fund Futures that were pricing a cut in the back half of 2023, you get the narrative. It doesn't mean it's right. It doesn't even mean that most investors believe there's a cut coming, there's a pivot coming. But it gives the financial media a narrative. It makes no sense. The Fed has told us XYZ. They have gone along with what they've said every step of the way. But the media makes us second guess things. They put things in our head, this pivot scenario. You've got Josh Brown saying this on CNBC. You got Dan Nathan saying that, and Guy Adami saying this. Well, investors believe a pivot's coming, and I don't know what the... Here's the thing. Not a single person on these shows believes a cut is coming, but everybody else must for price to go higher, for the S&P 500 to go higher. Nobody on CNBC, nobody on Bloomberg believes in a cut coming. The rest of you are schmucks. And that's why the S&P 500 is going higher. Does that sound right? We're all idiots. And that's the other thing, right? The market, they make this false, they report this false premise. The market is doing this because of that. And it's usually a false premise. So it just, becomes it's like a snowball. It becomes a hot button topic and it goes on and on and on, even though there's no validity to it. So, all right. Let's see. This feels like '03, so effing much. And the market top 2021. Just look at Oregon. There are a lot of similarities between 2002 and today, right? So speaking of 2003 was the new bull market, right? The new cyclical bull market in a longer secular bear market. When did we bottom in 2002? Exactly. October. When did we bottom during this cycle? Exactly. October. We've bottomed in most bear markets have bottomed in the month of October. So when people talk about seasonality, it's not by accident. It's not by accident. There's a lot that goes on. If you look at this from a fund manager's perspective, right? For those of you who have not, worked in the industry or what, I've consulted for hedge funds. I still consult for several hedge funds today. I don't want leverage. I'm not investing. What the hell are you doing with your client's money? I'm earning fees. That's how this business is run. It's fees. If you make money, good. But if I can't keep your money in my firm, in my fund, no good. What's the number one way to keep money in the fund? Small drawdowns. Small drawdowns. What's the best way to have small drawdowns throughout the course of any year? Low leverage. Minimal exposure to the market for at least 3/4 of the year. But when the fourth quarter comes around, what are my choices? How do I explain that I didn't do anything all year with your capital? I told you I wasn't a buyer in Q1 when I sent you your report with your balance statement. I did the same thing in Q2. I did the same thing in Q3. I'm waiting for value. Now the market's going higher. It's why most funds have, they get their greatest exposure in the fourth quarter, right? You hear the Santa Claus rally, from November to April are the best 6 months to own stocks because fund managers eventually have to allocate. Why don't we have back-to-back down years? Why are they so rare? Again, it's the same thing. I need to keep your money in my fund as long as possible if I'm a fund manager. But at some point, I can't lie to you. I'm charging you to manage your funds, not to sit on them, not to charge you 2, 3, 4% a year to manage them just by sitting them in cash. At some point, I have to justify why I didn't allocate more when there was value by basically chasing the market. And most of that chasing is done in the fourth quarter. It's when most hedge funds have their greatest, leverage or exposure to the market. But yeah, that's why most market bottoms happen in October. It's the start of the fourth quarter where, fund managers, portfolio managers, you have your risk parity, your CTAs, commodity trading advisors. You have your long equity portfolio. They've got to start buying. How do you justify to your clients that you did nothing all year? So a lot of market bottoms in October in the fourth quarter. Why is Morgan Stanley, who has some very sophisticated modeling, look at a 20% drawdown so strongly? When all you do is look down, That's the nature of Morgan Stanley. That's the nature of their analyst. Again, how do they generate fees? How do they get interest? Most of what these institutions are offering are mutual funds to elderly retirees and what have you. You have to disassociate or distinguish between who they're actually talking to. Right? When we listen to these folks in the financial media world, we think that they're talking to us. We think that they're talking to 20, 30, 40-year olds. They're not. That's not their clientele. Like 60, 70% of their clientele are retirees that are in bond funds or some kind of extremely diversified income funds and mutual funds. That's it. They're very, they're low risk. That's who they're talking to. There's no risk there for them. There's no risk as an institution, as Morgan Stanley, as Mike Wilson, who is their chief equity strategist. There's no risk to him, so far as being cautious. Their clientele are income, they just want something that'll earn them more than their savings account, something they can pass down to, their children and their heirs, if you will. But in general, that's Mike Wilson. He calls it, for a correction every month of every quarter of every year. I've been following him since 2016. At Phenom Group, we get the official reports. We disseminate them on our website to our members. So they get our proprietary research, my works, Edwards works. We get JP Morgan, we get Fundstrat, we get various other Morgan Stanley and other institutions. Like I said, I believe that investors should have a wealth of opinions, a diversity of opinions. They shouldn't just be listening to the bulls, shouldn't just be listening to the bears, but take it all in. And as you track these people over time, you're able to distinguish between, okay, wait a second, the world can't be ending every single day, every single year. It can't be. And things are not perfect either every single day of every single year. You over time, you're able to put them in the blender and realize, the posture, of the different institutions and the different analysts. Mike Wilson is, as long as I've been following him, is just a perma bear. He was great in terms of, I don't want to say calling the bottom, but saying buy in March of 2020. And what people try to, erase is the fact that in May, and every single month after, if you follow me on Twitter, you've seen, I posted, the reports back in 2020 where he was calling for a correction in May, called for a 10% correction in June, July, into the end of the year, and it didn't happen. We did have an 8% consolidation in June, for those of you who know your market history or were participating back then, but that was it. And he just every single month. 10% correction. And then because it didn't happen in 2021, he said, valuations, they're too high. And historically, he's not wrong. He wasn't lying to anybody. He wasn't, misinforming, right? We had a 22 PE in the S&P 500 on a forward basis in 2021. It was high. But it didn't sway the market. He didn't get a 15 because he called for a 15% correction in 2021 at the onset of the year. And because it didn't happen by mid-year, you didn't hear much out of Mike Wilson. He wasn't on CNBC, that's for darn sure. Right? It was a lot of Tony Dwyer, Canaccord Genuity, who I had to convince to get on the boat in April of 2020. I had to convince him. We had private, messages that we were sending back and forth to each other. Like, Tony, no, because his argument was that in March, we had, in May, this was in May, I had to get him on the boat. In April, because we had that 10%, 11%, I think it was, April of 2020, coming out of the COVID bottom, we had an 11% gain for the month. And his argument was we pulled things forward. We pulled the gains for the year forward. And I was telling Tony, no, that's not how this works. I look at breadth data. I look at my, monthly data when we've had 10% gains in a single month historically going back to 1950. No, something dynamic has changed investor behavior to elicit that kind of a gain in 1 month. that doesn't just stop. So I shared that data with Tony. I get it. You're skeptical because it's rare. Like the sample size isn't huge. I think it was like 13 times it's happened going back to 1950. But that is statistically significant. For sample sizes, you want six or better. For any study, you want six or better. If you haven't heard that before, I always go on tangents. I apologize. But okay, bringing it back to center. So that's Mike Wilson. Mike Wilson is running the same playbook. Mike Wilson, Morgan Stanley, he's running the same playbook that was run, right? We had the technical bear market, right? Because it wasn't a closing. We dropped 20% in Q4 of 2018. Most of you remember that. 2018, we had that nasty bear market that basically culminated at Christmas Eve. It was the worst. It was the Christmas Eve massacre. So we dropped 20%, basically from, I think it was October 5th to Christmas Eve. On a technical, we barely closed above the 20% threshold that day, but we did breach it intraday. So it's a technical bear market. And in all year, Mike Wilson, CNBC, articles in Market Watch, it's a rolling bear market, right? That he coined that phrase back in 2018. Good stuff. I mean, he nailed it. We were raising rates, running off the Fed's balance sheet, and the market was struggling after a year where it did nothing but go up in 2017, right? I think we had a 19-20+% gain that year. But markets don't like to do that back to back to back years. So we had that 20% drawdown. We had the trade war, which only exacerbated itself in 2019. But what happened? The first trading day back after Christmas Eve, still 2018, took off like a rocket ship into 2019. Where was Mike Wilson? What was the Morgan Stanley pitch then? We believe that the bear market will continue in 2019. Valuations are too high, earnings recession. It's the same thing that he's saying this year, folks. Bear market will continue. Valuations are too high and an earnings recession. He's not calling for it. His base case is not a recession in the economy, but a recession for earnings. Do want to make that distinction. Doesn't make it any better. He wasn't calling for a recession back in 2019 either, even when the yield curve inverted. Wasn't calling for a recession. 2,750 was his price target. 2,750. Essentially, the market would go nowhere for 2019. Again, for those of you who know market history, you remember. Market ran higher 31% on a total return basis that year. But he's always looking down. It wasn't as if, that was a great call in 2018. That is Morgan Stanley. That is Mike Wilson's forever call. There's always a correction. There's always a bear market looming. At the end of the day, as investors, we have to say, what can I do with this information? Look, this is investing capital. I'm either going to invest it or I'm not an investor. So what if the market goes down? It went down last year 20+%, 25% on a closing basis, 28% intraday, 28%. What happened last year? I always ask this to be, what happened last year? Right? Nothing actually happened. For all of the bearish commentary, for all of the doomsayers reporting, nothing really happened. Slow growth environment, still earnings growth that tapered off into the end of the year. But for all of that commentary, for all of that sitting on the sidelines, what actually happened? Nothing. We derated 25% on the closing basis because the equity was the biggest issue. Rates, yields go up and up and up. Extreme difficult, for the equity risk premium. People don't feel they're getting the value that they deserve. But again, that can only last so long, right? That was 1 year where fund managers outperformed the market. Going back to our earlier conversations, how do you outperform the market in the down year? Well, I don't have that much leverage to the market anyway. I never do. This year, it just happened to work for me. So I outperformed. Still a decline. You still have some exposure. But in general, most fund managers, they're not over leveraged. They're not even equal weight the market. So they can outperform on down years. And it's the only time they outperform as a whole. And they always underperform the market when the market goes up because they don't have enough leverage to the market. All right. Let's see what else we got here. Again, good questions, everybody. Thank you. Yeah, every year emerging markets are supposed to outperform every single year, right? that just gets re-upped every year and it just never comes to fruition. I work at MS and all of the advisors I talk to, zero have shown admiration for Wilson. Well, most of his colleagues that I've, either befriended or come across at different, venues, events over the years, what's a nice way to put it? They're not enamored with him as an individual. I think that's the best way to put it, right? So now here's the funny thing, okay? Because right, he'll catch a lot of flack, but Morgan Stanley and all of their weekly reports, they have a basket of longs. This is what they encourage their clientele to buy and own. And it does well. Again, as long as I've been a subscriber and received their research, that basket does well. But if you're a client of Morgan Stanley and they're constantly pounding the table that the market is going down, correction is the corner, the economy's for crap, how do you ever feel comfortable buying that basket of stocks that they're advising? That's why I say anything that you are reading in terms of market research, watching in terms of financial media, the question I always encourage investors to ask is this practical insight and information? What can I do with this? For those of you who've seen the movie Departed, one of my favorite movies, where Jack Nicholson says to Leonardo DiCaprio, I look at you and I say, what can I use you for? It's the same thing with the market information and research. What can I use it for? Is it practical or is it noise? It's one thing to be informed, it's another to be afraid. When you get to the point where you're afraid because of that information flow, you're becoming your own worst enemy as an investor or trader. You want to avoid that. you got if you're afraid to allocate, if you're afraid to buy value when things are going down, you've got a practical problem that you have to solve. Your job is to buy value. Your job buy low. It's a bear market. That's opportunity. Bull markets are made on the backs of bear markets. You take your drawdown like a big boy and girl, and you wait for the inevitable, as history has taught us. You wait for the inevitable resurgence. So it didn't happen last year, and we had the longest, deepest recession, bear market without a recession. It was the longest and deepest without a recession. It's really overlooked, which is why a lot of these people, they just kind of moved out their recession calls. They moved it further out. They moved the new bear market call further out. As if last year market just fell cuz. It felt like it, just cuz. You can't win for trying, right? All right, let's see. An interesting thing I heard recently about allocating capital is when advisors use back testing to allocate to winning sectors. But 2022 was such an extremity of return. Yeah, yeah. A lot. There was so much in the way of historic data, positioning, sector rotate that didn't work. And that was a dynamic of nothing working. Right? It was the third worst 60-40 portfolio performance in history. That goes a long way to explaining nothing worked last year. Even towards the end of the year, a lot of the gains in the defensive sectors, the defensive areas of the market, we're on the verge of evaporating. So, good point. Last comment I see here. I think June was the Delta variant, though. Wilson didn't predict a new variant strain. The European markets and all markets went haywire. Yeah, yeah, that was the second wave over there in Europe, or third wave over there in Europe. So, yeah, good stuff. All right, well, we've been here an hour. I'm going to call it a wrap. Thank you for those of you who came and participated. If you liked it, appreciate the feedback, and we'll probably do more of these as the year progresses. And forgive me for this sales pitch, if you will, but if you appreciate the things that I share on Twitter, you like my tweets and what have you, the information, the data that I produce, the technicals that I produce, feel free to join us at phenomgroup.com. We have two level memberships if you just want to dip your toe in the water, which is our contributor membership, which gives you access to our state of the market videos and our weekly macro market research report. Occasionally, I also let our contributor members into our live daily trading room, like once or twice every couple of weeks, so they can see and hear from me, in real time as the markets are doing what they're doing. But that particular membership is only $14.99 a month. No, you're not locked in for anything but that first month, and you can cancel anytime if you think, this is good stuff, but it's just not for me, or it's not practically, it's not your risk tolerance. It doesn't speak to what you want to do as an investor or trader. No harm, no foul. But that's our $14.99 membership. Our full scale premium membership gives you access to the macro market reports, as well as our state of the market. But you also get my investment ideas. You get our daily, weekly, monthly trade alerts, and you get access to our live trading room Monday through Friday, 8:15 to 4 o'clock. Also, we do a lot of third-party research, disseminations, at phenomgroup.com. So you have access to all that as well for both membership levels, the contributor as well as the premium. Other than that, you know where to reach me. If you have any questions, you can always give me a DM, message me on Twitter. You can hit me up in our contact form at phenomgroup.com as well. So until tomorrow, folks, enjoy your evening, and we'll see how the markets look when we wake up and futures are rocking and rolling. Take care, everybody.